Welcome back to the channel. My name is Mac Rogers. In this video, we will talk about the rising mortgage rates, mortgage applications going down again. We'll touch a little bit on forbearance. We will also look at this trending TikTok video about the Zillow iBuyer program conspiracy theory. And finally, we'll tie this all up at the end and answer the question, what do supply and demand tell us about today's housing market? So, oh boy, here we go. Finally, mortgage rates are up. Every Thursday, Freddie Mac releases the result of their primary mortgage market survey, which reveals the most recent movement in the 30-year fixed mortgage rate. Last week, the rate was announced as 3.01%. It was the first time in 3 months that mortgage rates surpassed 3%. In a press release accompanying the survey, Sam Cater, chief economist at Freddie Mac, explains, quote, mortgage rates rose across all loan types this week as the 10-year U.S. Treasury yield reached its highest point since June. The reason Sam Cater mentions the 10-year U.S. Treasury yield is because there has been a very strong relationship between the yield and the 30-year mortgage rate over the last 5 decades. Here's a graph showing that relationship. This is definitely not good news, not only because rates are high or climbing higher, but also because in conjunction with the recent slowdown, this will only add more fuel to the fear that's going around. And that is, real estate prices will start going down. Check out this next graph that I have here. As you can see, for almost 50 years, the 30-year mortgage and 10-year treasury has moved in unison. The relationship has also been consistent throughout 2021, as evidenced by this following graph. The graph also reveals the most recent jump in mortgage rates was preceded by a jump in the 10-year treasury rate. That's the red circles here. So, what impacts yield rate? According to Investopedia, there are a number of economic factors that impact treasury yields, such as interest rates, inflation, and economic growth. Since there are currently concerns about inflation and the economic growth due to the pandemic, the treasury yield spiked last week. That spike impacted mortgage rate. You've seen how the Senate and Congress keeps going back and forth about the budget. There's a lot of concern about inflation and the economy as a whole. So what does this mean for you? Well, I said it before, expect mortgage rates to continue to rise modestly, which will have an impact on home prices. It may not cause it to crash. In fact, there's no sign of that, but definitely causing them to slow down after our years of amazing growth. So is it time to panic? Well, not necessarily. Even as we continue to increase, we are still coming from historic lows, which means that these increases in the coming months, they're still palatable. I personally think that anything under 4% is still good and would probably have very little impact on the market. Now, if it gets to 4% or higher, that's a whole different thing. The National Association of Realtors forecast the 30-year fixed mortgage rate to reach 3.5% by mid-2022. I think it might be faster than that. So the bottom line for increasing mortgage rates, forecasting mortgage rates is very difficult. We don't know where it's truly headed. The last couple of years, it seemed like every month we were told that rates were going to go up. And it didn't until now. That being said, if you're either a first-time homebuyer or a current homeowner thinking of moving into a home that better fits your current needs, keep abreast of what's happening with mortgage rates. It may very well impact your decision. With mortgage rates increasing, guess what's happening to mortgage application? Mortgage applications dropped by 6.9% for the week ending October 1st. That's the second week in a row. The biggest drop can be attributed to less refi borrowers. The refi index dipped by 10% from the previous week. This is the lowest level in 3 months. In terms of purchase applications, the decrease was by 2% from the prior week. When compared to a year ago, the index dropped by 15%. The breakdown is as follows. Purchase index down 13% and the refi index down 16%. I guess it shouldn't be a surprise that refinance applications would decline given that mortgage rates are climbing. A lot of homeowners have very low mortgage interest rates right now. In the forbearance front, more good news. According to the Mortgage Bankers Association's latest survey, the total number of loans now in forbearance decreased from 2.96% to 2.89% as of September 26, 2021. According to the MBA's estimate, 1.4 million homeowners are still in forbearance plan. The MBA said that, quote, the share of loans in forbearance declined at a faster rate last week, dropping by 7 basis points as exits increased and new requests and re-entries declined. While 1.4 million homeowners remained in the forbearance as of September 26, this number is expected to drop sharply over the next few weeks as many more reaching the 18-month expiration point of their forbearance terms. Most borrowers exiting forbearance through a workout are opting for a deferral plan which allows them to resume their original payment while moving the foregone amount to the end of the loan. Translation: I've covered this before. A majority of the borrowers exiting forbearance are either paying off their mortgage or getting a workout plan with their lender, or in some cases opting to sell their property. So nothing really new on the forbearance front. Next topic, iBuyers. You've probably seen or heard this agent in Las Vegas that did a TikTok video in regards to iBuyers. Now, if you haven't seen it, don't worry, it's not worth watching. Basically, the premise of the video was that there could technically be some market manipulation or price fixing going on. And this is how it goes. First of all, he didn't name any companies in the video, but the assumption is that the company or companies that he might be referring to could be Zillow, Redfin, or Opendoor. These are the companies that have iBuyer programs. Basically, he laid out a theory this way. Said company would start buying up to, let's say, 30 properties in a neighborhood for $300,000, and then on the 31st property that they buy, they deliberately buy it at an inflated price of $340,000. And bingo, you have a new comp that's $40,000 higher than the last sale. First of all, from the very beginning when I heard about this, I thought it was stupid, idiotic, and dumb, and he had no idea what he was talking about. But then I realized that we live in a world where we crave likes, videos, attention, and I thought this topic was a genius. So I'm talking about it also so that you may click the video, like it, watch it, share it, and subscribe. Now, here's the theory that doesn't hold water. It's no good. First of all, I know of no market wherein someone or some company can come in and buy all the houses that are available and dictate their price in the current market that we have. 2 words for you: seller's market. We have been in a seller's market for the last several years. Buyers don't dictate price, sellers do. Now, if it was a buyer's market and we have a ton of supply sitting on the market, yes, it's feasible because at that point, you or whatever company might be the only buyers out there. Most sellers go with so-called iBuyer programs because they want a quick sale. In those instances, companies can buy properties that are below market. But again, in our current market condition, there's very few sellers that do this because they could potentially be leaving thousands of dollars on the table. The other thing is the last sale doesn't all of a sudden dictate the price for all the other properties just because it was bought at a higher price. This is an oversimplification of the whole buying and selling process. The bottom line is that this is feasible, but not at our current market environment. It's not that simple, and most likely if it was done on a massive scale, the feds would be all over it because it's price fixing. Again, don't waste your time watching the video. Better watch cat videos instead. Finally, let's tackle this question. What do supply and demand tell us about today's housing market? There's a well-known economic theory, the law of supply and demand. That explains what's happening with prices in the current real estate market. Put simply, when demand for an item is high, prices rise. When supply of the item increases, prices fall. Of course, when demand is very high and supply is very low, prices can rise significantly, just like what we're going through right now. Understanding the impact both supply and demand have can provide answers to a few popular questions about today's housing market. Questions like, why are prices increasing? Where are prices headed? What does this mean for home buyers? So let's look at why are prices increasing. According to the latest Home Price Insights report from CoreLogic, home prices have risen 18.1% since this time last year. But what's driving the increase? Recent buyer and seller activity from the National Association of Realtors helps answer that question. When we take NAR's buyer activity data and compare it to the seller traffic during the same time frame, we can see buyer demand continues to outpace seller activity by a wide margin. In other words, the demand for homes is significantly greater than the current supply that's available to buy. This combination of low supply and high demand is what's driving home prices up. Bill McBride, author of the Calculated Risk blog, puts it best by saying this, quote, "By some measure, house prices seem high, but the recent price increases make sense from a supply and demand perspective. In other words, no bubble." The second question, where are prices headed? The supply of homes for sale will greatly affect where prices head over the next coming months. Many experts forecast prices will continue to increase, but they will likely appreciate at a slower rate. Buyers hoping to purchase the home of their dreams may see this as a welcome news. In this case, perspective is important. A slight moderation in home prices does not mean prices will depreciate or fall. Price increases may occur at a slower pace, but experts still expect them to rise. 5 major entities that closely follow the real estate market forecast home prices will continue appreciating through 2022. The third question, what does this mean for home buyers? If you're waiting to enter the market because you're expecting prices to drop, you may end up paying more in the long run. Even if price increases occur at a slower rate next year, prices are still projected to rise. That means the home of your dreams will likely cost you even more in 2022, including increasing interest rates. So the bottom line, the truth is high demand and low supply is what's driving home prices in today's housing market. And while prices may increase at a slower pace in the coming months, experts still expect them to rise. If you're a potential home buyer, let's connect today to discuss what it could mean for you if you wait a little bit longer. That's our video update for this week. Thanks for watching.